Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a fantastic show for you this morning. Of course, we will be taking your questions. Send them to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com. We have upcoming workshops, education for pre-retirees, and retirees. You know, Rezny Wealth is all about protecting you, the investor, from bad advice from Wall Street firms, banks, and annuity salespeople that unfortunately don't legally work in your best interest 100% of the time. Too often we see retirees and pre-retirees alike, their retirement decimated, their portfolio ruined by poor investment advice and really just being sold a bunch of junky investments from these various firms that claim to work in your best interest, but they do not. Remember, as an investor, it's up to you to do your own homework. Make sure the only firm you entrust your money to is a fee-only fiduciary money manager. No bank, no Wall Street firm, no insurance company is a fee-only fiduciary. Some may work fee-based. That is not fee-only, and suitability should never be part of your portfolio. You know, I want to talk about the economy, of course, and I want to talk about where we are headed this year and of course, over the next maybe few years. Our crystal ball, generally speaking, because we do a lot of research daily on the economy, is pretty good about 9 months out. If we look at the economy now, we look at an economy that's growing, maybe a little bit slower than last year, but still growing. What's interesting, though, if you listen to a lot of the big Wall Street firms and banks last year, they were all calling for recession in November and December of last year. They were completely wrong. In fact, we received a lot of calls from people with these big firms that basically their brokers, so-called advisors, had them get more conservative after the market already dropped, only to miss a lot of the recoup when we went into the new year of 2019. You, the investor, have to realize, make sure you understand where the advice you're getting is coming from. Is it real advice? Is it real money management? And is it in your legal best interest from a fee-only fiduciary money manager? Let's talk about a recession. And I want to talk about a recession because, again, Wall Street and banks were 100% wrong last year in 2018. And by the way, in 2017, 2016, 2015, a lot of them were calling for recessions every time we had these moderate pullbacks of, let's say, 8 to 10% in the equity market. They were wrong every one of those years. And I'm glad to say that if you listen to my live radio show or my TV shows, I've repeatedly said we were not in a recession, garden variety pullback. Now, we may be in a recession one day. It may be a week from now or 5 years from now or somewhere between, but we do a lot of research, as I said earlier. The big key is this. A recession is coming. The next big market correction will come. What is your risk management strategy? So we're going to talk about a recession. What does it mean? What brings about a recession? But the big key is this. What is your strategy for the next recession? Not this inter-year volatility we see every single year. And by the way, if you look at 2018, we had inter-year volatility in the stock market. We also had that in the bond market. Real estate, gold, oil, everything has inter-year volatility. That is normal. The big key, though, is this. A recession, when it hits, what's your strategy to reduce your major risk? Unfortunately, if you're with one of those big banks and Wall Street firms, you probably have no strategy to manage the risk because most of those firms do what's called buy and hold asset allocation. We call it set it and forget it. Plain and simple. The market, the bull market that we currently see today, in our opinion, will stay in place until one of two things happen. A recession appears on the horizon, and that's from an overheated economy, people spending more money than they can keep up with, kind of like we saw in 2008, people buying a lot of houses and cars they couldn't afford. Eventually, they overspend, the economy slows down, it's a recession. We're not seeing that currently. Or the stock market becomes grossly overvalued, kind of like a bubble like we saw in the year of 2000. Again, neither one of those we see today. Now, again, that may change in the next month or 2 months or the next 5 or 10 years or somewhere between. The key is this, folks. Daily research on the economy. Is it growing? Is it overheated? And once you start to see those signs of a recession, what is your risk management strategy? And what that means to us is simple. If you're a growth investor, you would start reducing the risk of your portfolio and get more conservative. So hopefully you have a less of a drawdown of capital. Unfortunately, again, your Wall Street firm and bank believe in asset allocation, always in the market, always invested, never reducing risk in our opinion. This could be catastrophic to your portfolio and your retirement. Right now, the U.S. economy data shows no signs of recession, as I made a comment earlier. In fact, GDP is healthier now than in any previous point since this rally really started. We're seeing positive GDP growth. Remember, gross domestic product. Is the economy growing? The way that you look at investing your money is pretty simple. Is the economy growing? Then there's an opportunity for corporations or the stock market to make bigger earnings, which gives you then the opportunity for your portfolio, if you're invested correctly, to go up in the right direction. If GDP, gross domestic product, is starting to contract and roll over, that means corporate profits are starting to go down, and ultimately your portfolio will probably go down. The last two recessions, in 2008 and the year 2000, the equity market declined more than 50%. If you take a look at the S&P 500. The big key again is, what is your risk management strategy going forward? And again, your Wall Street firm, bank, insurance company, asset allocation, buy and hold, set it and forget it. It didn't work last time, and I'll tell you what, it probably is not going to work in the next recession. So make sure you have yourself a risk management strategy to protect big drawdowns of capital, get conservative when you need to, and add that risk back on when things are very cheap and inexpensive again. And yes, the overall equity market today is fairly valued. But that doesn't mean that the market can't still have the opportunity to go up. If earnings go up, then the stock market often follows. So again, if earnings go up, there's an opportunity for that stock market to go higher. If earnings go down again, that's when equity prices could really come down, and that often occurs in a major recession. Long story short, you should stay fully and properly invested until a recession appears imminent and stocks become overvalued or bubblicious, as we call it. Right now, we're not seeing that. But again, what is your risk management strategy? Because your Wall Street firm, bank, and insurance company probably doesn't have one. We've got a couple upcoming workshops. If you're a retiree or pre-retiree and you want to learn the disturbing facts most investors are shocked to learn, come to one of our upcoming workshops. We're going to teach you the true cause of poor investment returns and how to fix it. You're going to learn how to grow and protect your wealth from bad advice. We have two locations, one in Fort Myers and one in Naples. Go to ReznyWealth.com for details about our upcoming workshops and to sign up. We don't take walk-ins, and you can't call the office. You've got to visit our website to sign up. That's the only way for times availability. Go to ReznyWealth.com. And again, if you're questioning the advice you're getting, if you want to learn about real money management, and you want to find out the facts about bad investment performance and how to curtail or fix bad advice, attend one of our upcoming workshops. Become educated. It empowers you, in our opinion, to have the opportunity to do greatly better than you're doing today. Wayne from Naples, Florida. Is the current market volatility indicative of a correction? How long could it last or potentially last? Wayne, that's a great question. Remember, we have volatility not only in the equity market, because everybody always wants to talk about the stock market and volatility. But every asset category has volatility throughout every calendar year. If you look at statistical numbers, the equity or stock market will usually have a 10% correction once every single year. It doesn't mean you lost money. It means maybe the market went up 10%, came down 10%, and then maybe goes back to a new high. That is typical in any calendar year. Bonds have volatility. Real estate has volatility. This is that inter-year. So what I will say to you is this. Volatility is normal. As long as you are invested properly, you have a risk management strategy for the next recession, you have to accept normal inter-year volatility. Now, you can bring some of that down a little bit on how you allocate your money or how you invest, but if you're going to get rid of all volatility, you're probably not going to make much money, and you might as well stick your money in the bank in a CD, because if you can't accept any of this over the long term, you have no chance to make any real return on your money, in our opinion, and you're better off to go put your money in the bank, in a CD that's really protected by the government. I'm going to take a quick break. Go to our website, ReznyWealth.com. And as I've always said, bad advice does not fix itself. If you're concerned about the advice you're receiving, go to ReznyWealth.com. Schedule a consultation with our firm. We've got offices right here in Naples and in Fort Myers. I'll be right back with more questions after this. Would you hire an arsonist to put out your house fire? Of course you wouldn't. Hello, I'm Brian Rezny, president of Rezny Wealth Management. The sad fact is, your advisor is probably burning down your retirement right now and you don't even know it. Fee-only fiduciary versus suitability. Who do you entrust your life savings? A real advisor or an arsonist? Visit ReznyWealth.com for the facts. Hello, we're back. I'm Brian Rezny, president of Rezny Wealth Management. Rezny Wealth Management, a fee-only fiduciary money manager, providing exactly what you need. Real advice, real money management without the shenanigans and the conflicts of Wall Street firms, banks, and annuity salespeople. If you're concerned about the advice you're getting, call Rezny Wealth Management or visit our website at ReznyWealth.com. John in Cape Coral, Florida. I'm curious about the impact of the Fed's recent interest rate increase. Do you think that higher interest rates are going to hurt the overall economy? John, generally speaking, interest rates in the U.S. are still very, very low. Although the Fed has acknowledged that the economy is going to probably have slower growth this year than it did last year. And at this point, it seems that they're going to be more of a wait-and-see attitude. So while we may see another interest rate increase this year, we actually may not see an interest rate increase this year. It depends on what the Fed sees. Interest rates going up slowly, to me, isn't going to really hurt the economy. If they raise rates too quickly, that definitely could have a negative impact, not only on the economy, but also potentially throw us into a recession. I do not see that currently. But then again, remember, we are an active money management firm. We spend a lot of time looking at and researching the economy and the direction of the economy. So if the situation changes and the facts that we are given change, we'll again change our opinion. But right now, we see a growing economy. We see interest rates fairly stable this year, and probably either one or potentially no interest rate increases, depending where unemployment is and inflation, which is a big mandate by the Fed. Mike from Bonita Springs, Florida. With the recent market sell-off, you must be getting a lot of calls with concerns. Do you recommend getting more conservative until things start really going up again? Mike, I don't know if you've noticed, but we've actually seen some good increases from the bottom that we really saw in 2018. Just because there's this volatility, I can tell you as a firm, we do not get a lot of calls or emails from existing clients because we educate our clients well, and in our opinion, education really helps the client feel at ease. And also, because we're an actual money manager, we're doing what our clients expect us to do, properly manage their wealth. So with education and proper management, we really don't get a lot of calls from existing clients. But I will say we do get a lot of calls from TV and radio show listeners. In fact, they go up multiple times when we get market volatility. What's interesting is most investors don't really look at their portfolio much until things get volatile. That's really the wrong time. You should be looking at your portfolio from day one, and it should be constantly researched. Unfortunately, the vast majority of investors who are do-it-yourself investors really don't spend a lot of real time on research and don't really run a real strategy. The other sad fact is your Wall Street firm probably isn't really managing your money at all because chances are you're just being sold investments under suitability. So I can understand the concern that a lot of people will have that are outside of our business. There's a lot of bad management out there. There's a lot of bad advice. And there's a lot of lack of education and communication by a lot of these big name firms. I think that's the detriment of you, the investor. That's one of the things that I talk about at our upcoming workshops. Bad advice doesn't fix itself, and if you're communicated well and you're educated by your advisor, you should feel at ease and hopefully weather the storm. We do have 2 upcoming workshops right now. The disturbing facts most investors are shocked to learn: the true cause of poor investment returns and how to fix it. If you're concerned about how your money's being managed, you're concerned about lackluster performance, if you want to learn how to avoid bad investment advice, you should attend one of my upcoming workshops. We've got one in Naples and one in Fort Myers coming up. Visit ReznyWealth.com for times and availability, and also to sign up. The only way to sign up for any of our workshops are via our website, ReznyWealth.com. One of the comments that I often get from people that attend our workshops, by the way, I should have learned this 20 or 30 years ago. In our opinion, the average investor who's age 65 has 2/3 less investment net worth. Why is that in our opinion? Because of bad advice the last 30 years. Because you were sold things you shouldn't have been sold, your money maybe was never properly managed, high expenses, I can go on and on. But if you're 65 and you're married, there's a likelihood one of you will easily live into your 90s. You could have another 25 or 30 years ahead of you. Fix the bad advice now. Procrastination doesn't help, folks. You need to hit this head on. If you have any concerns about the advice you're getting, if you've learned from my show about how bad annuities are, or non-traded REITs, or how asset allocation has failed you, the investor, then you should attend one of our workshops, or maybe better yet, call my firm for a consultation and schedule a second opinion if you're looking for money management and you're looking for real advice. Angela from Fort Myers, Florida. I'm planning on retiring next year and have done pretty well in my 401k plan. I have about 80% in stock, 20% in bond. What worries me is when I retire, the bull market will end, and so goes my portfolio, I guess is a good way to put it. Any advice? Yes, Angela. The key is this. If you have a 401k plan, you are self-managing it right now. You have to decide where to put the money. Do the hard research. If you hire an investment advisory firm, a money management firm, and again, only a fee-only fiduciary, then you could have somebody that actually can help manage the money for you and help massage, move the money, fine-tune the money as the economic scenario changes. So what I would suggest to you is this. I wouldn't worry about the bull market being over. What I would worry about is the next 30 years of your retirement and making sure that what you have now is properly managed to provide the income you're going to need that will grow over time because of inflation, and the growth you're going to need, again, to combat inflation. So if you're concerned about the bull market being over, what are you going to do if the economy changes direction? Maybe you should be in different areas of the portfolio. Maybe you should be more aggressive, more conservative, more income, less taxes. All these different things need to be built into place. A qualified money management firm can help you. Rezny Wealth Management would be one of those firms. You can always give us a call. We can discuss your portfolio in more detail and help build a plan that is right for you. Colleen from North Fort Myers, Florida. I have a variable annuity with Prudential for $600,000. It's done very poor for the last 10 years, maybe up 40%. I know you hate annuities. What would you do? Colleen, great question. I'm going to talk about variable annuities overall. And because I don't know which Prudential annuity you have, it's going to be hard for me to give you exact numbers on the expense ratio. But annuities in general, variable annuities are very high expense ratio. Typically, from the ones we've reviewed, 3.5% to 4.5% annual expense ratio every single year is typical. Mediocre investments are also prevalent, we find, in most of these variable annuities. So high expenses, mediocre investments equal probably bad returns. You're telling me in the last 10 years you've made 40%. Well, depending how you were allocated, how you were invested in that annuity, you probably should have done a lot better than that, to be brutally honest. But the reason that your returns are bad is because the expenses are so high. So imagine this. Let's just say you're invested in a balanced portfolio, and a balanced portfolio the last 10 years has made 10% a year, just for talking numbers. And your expense ratio on your annuities, 4.5% a year. Well, if the portfolio should have done 10, but you've got 4.5% of expense ratio, what are you actually making? 5.5%. You're making almost half what a balanced portfolio should have made in theory. Expenses matter. Quality of investments matter. I've never seen a variable annuity that was beneficial for the client. I've only seen the beneficial for the insurance company and the agent or broker selling them. Annuities, in our opinion, are garbage because of the expenses and lousy investments. But unfortunately, these so-called advisors with banks, Wall Street, and annuity salespeople love selling them because it lines their pocket greatly and ultimately, Colleen, takes away from your financial security. I got to take a quick break. Go to ReznyWealth.com. That's ReznyWealth.com. Learn about why annuities are dangerous to your wealth and retirement. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. 30 years of professionally managed investments, I've seen a lot of investors make mistakes. As I've always said, learn from others' mistakes so you can profit. Read my free report, 3 investment risks investors must avoid now, available on our website at ReznyWealth.com. And we're back. I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. Go to our website, ReznyWealth.com, download any of our groundbreaking free reports. You will learn what you should have learned 30 years ago. But remember, whether you're 50, you're 70, or 80, if you learn today to avoid bad advice, you're only going to profit, in our opinion. Pat from Naples, Florida. Is the Fed going to continue to increase interest rates, and what would be the effect on the markets? Pat, I talked about this a little bit earlier, and I know there's people concerned about interest rates going up. Ultimately, I think the economy is stable. The Fed is looking at a wait-and-see attitude from their language. So what I would anticipate is either no rate increases or maybe one more this year. That will not have a material impact on the economy, in our opinion. If they raise rates another 2 or 3 percentage points this year, which I do not see that happening, that could have a material impact. But the Fed is being friendly, meaning they're watching the data and they're making a decision based upon the fluid data that's coming through, which I think is a positive. So again, I look at an equity market that has potential the rest of this year. I think there's areas that I would not be invested in. I'll give you an example. I would not put a penny into Europe. And I will tell you, when we get new clients that hire my firm every month, we often see these accounts coming over from the big Wall Street firms and the banks and the insurance people. What's interesting is they all do this, what's called stock asset allocation, this kind of chopped up pie chart. And they almost always have a bunch of Europe in the portfolio. Europe's been a disaster for decades. But your so-called advisor at most of these other firms are going to tell you, have Europe in there to diversify. Baloney. Europe isn't growing, and they're probably going into another recession. They seem to go into a recession every other year. It's a bad place to be invested. The U.S. is the strongest house on the block. I think it's of quality, but make sure you do your own research. Invest in areas that are growing, not staying flat or contracting. So again, U.S. looks very promising in our opinion. Europe is a bunch of garbage. I would not put a penny into that, even with my worst enemy's money. Yet a lot of you TV show listeners probably have a bunch of your money invested in European funds or international funds that have done really lousy compared to the U.S. marketplace. Why do you still own them? That's a good question you should be asking your so-called advisor. We've got 2 upcoming workshops. If you want to learn the disturbing facts most investors are shocked to learn, the true cause of poor investment returns and how to fix it, attend one of my upcoming workshops. We're going to teach you how to grow your wealth and protect your wealth from bad investment advice. If you've got any kind of concerns about the direction of your portfolio, you've got lackluster returns, you've been sold a bunch of crummy products from your Wall Street firm, whether they're annuities, non-traded REITs, you got that over-diversified asset allocation. Go to ReznyWealth.com. We've got 2 workshops, Naples, Fort Myers, coming up this month. You can sign up and look at the times and availability right on our website. This is perfect for you retirees and pre-retirees who have questions about the advice you're receiving or the direction your portfolio's truly headed. Go to ReznyWealth.com, sign up, you will be glad you did. Matt from Naples, Florida. Mom made a mistake. Annuities. Had lunch with mom, shared that she's unhappy she had with her advisor. She invested $200K in 2013 IRA index annuities, current value 130 of initial investment, lost $70K. Mom's status 68 and retired. What should we do? Matt, first off, I hate annuities. Annuities are garbage. Anybody who sells an annuity for commission should be complete suspect. These people are working under suitability. Under suitability, they do not work for you or your mother. They care about lining their pocket with the highest commission. That's all they care about. You can do it a better way, a cheaper way. So what I will tell you is this, without going into real detail and seeing your mother's actual index annuity contract, surrender periods, and expense ratio, I can't give you a straight answer what I would do. What I will suggest you do is get that contract out. Schedule a meeting with my office. Let's take a look at it. Let's see if there's options for her either to get out, maybe she has to revamp what she's got in that annuity, pick different indexing methods, whatever, but we need to look at the contract first so we can give you proper advice. And unfortunately, your mother is the same as a lot of people that we see that call my TV and radio shows every week. They've been sold these crummy annuities by what I call the annuity charlatans of the world. And again, there's a sucker born every day. I hate to tell you that, but unfortunately, people don't read the fine print, and they fall for this 8% returns that they're told by these annuity charlatans or these 10% bonuses. It is all garbage in, garbage out. Go to my website, ReznyWealth.com. Download for free Why Annuities Are Dangerous to Your Wealth and Retirement. You'll be glad you did. Dean from Fort Myers, Florida. What do you think about Trump's trade wars and its impact on the economy? I think it's great. I think ultimately we need to fix trade in this country. If we fix trade in this country, it's going to help the U.S. Ultimately, if the U.S. does good, obviously you as a U.S. citizen is going to do very, very well. We've had a trade problem in this country for decades and decades. This is not something that came about in the last 10 years. Unfortunately, our politicians have done a lousy job with trade, and because of that, the U.S. had suffered greatly. Lost jobs, lost businesses, lost opportunity. I feel that we need to fix trade, and ultimately this is a net positive for the U.S. Rezny Wealth Management, real advice, real money management. None of the conflicts or shenanigans of brokerage firms, banks, and annuity salespeople. My advice, never settle for bad advice. Pick up the phone, call my firm today. We manage portfolios $500,000 and larger. If you're concerned about the advice you're getting and you're looking for real advice, real money management, call Rezny Wealth Management and make sure you visit our website at ReznyWealth.com. Check out our workshop tab, sign up, educate yourself, protect your money from bad advice. Wall Street doesn't care about you, either do these annuity salespeople. They only care about commissions. I'll see you next week.